Hi, everyone. Wanted to give you a quick update today on the September FOMC meeting and what we've been seeing in the aftermath of that. The Fed added a little bit of moneyness at the September meeting with a set of forecasts that imply somewhat higher growth expectations and inflation expectations than they had back in the June meeting, but also somewhat better employment conditions. So the unemployment rate a little bit lower in 2026 and 2027 than had been forecasted at the last meeting. And what that all would imply is that, if anything, interest rates might be going up, not down, but you can see that bottom green box showing you the projected rate path from the median FOMC member is showing you a steeper decline in rates. 3 rate cuts in 2025 instead of just 2, and then 1 each in 2026 and 2027. So this is, needless to say, unusual. The idea that you'd be seeing an upgrade to growth and inflation, an upgrade to the employment outlook, but lower interest rates. And it means something different has happened to the Fed's reaction function to what's going on in the economy. One other thing to stress here, and this is also coming from the Fed's materials, this is the dot plot that's been around for now well over 10 years. And people have kind of learned to take it maybe seriously without taking it too literally. And I'll explain what I mean by that. There's a lot of uncertainty in this dot plot compared to other ones that we've seen. The range between the highest dot and the lowest dot, not only for the years out where we really can't know exactly what's going to be happening, but even for 2025, there's only 2 meetings left, and the range of dots is still quite wide. One more rate cut sort of is the minimum that you would expect. The bulk of the FOMC expects at least one more rate cut this year. That's priced in mostly for the next meeting, but also some odds priced in that there'll be 2 rate cuts. And that's really where the dividing line is. That's that dotted red line all the way on the left here, showing you that there's a very closely divided opinion between whether the Fed will cut twice more or once more in 2025. But what's even more interesting, if you go all the way to the right on this chart, the longer run rate, the sense that the Fed has of where the neutral rate is also seen as highly uncertain. There are members of the FOMC that think the 4% is the longer run neutral rate. It's about where the Fed is right now. And there are members that think that it's 2.5%, meaning the Fed could cut another 150 basis points before they got down to neutral, which implies that monetary policy is still quite restrictive. Who's right and who's wrong matters a heck of a lot for how the economy is going to behave over the next 2 to 3 years, not just over the balance of this year. Let's talk about the market response. Markets didn't really move much on net the afternoon the Fed met and they had the press conference with Jay Powell and released these new forecasts. The Fed pricing ended up about where it had started, with the market pricing in a somewhat steeper slope downward of interest rate cuts than the Fed itself had forecast. And that's not unusual. The Fed and the market don't always have to agree, especially when it comes to longer term horizons. The market thinks the Fed's going to get more dovish next year, regardless of what it does this year. And we agree, because the composition of the Fed is likely to change, including and especially the chair, who is likely to be a lot more dovish than Jay Powell if and when President Trump names his successor. Some of the beneficiaries of what has been this, I wouldn't say abrupt, but notable turn in the Fed's approach to handling the economy, with rate cuts now, despite the fact that inflation is still at 3%, despite the fact that unemployment is still at 4.3%, quite low by historical standards. Tips and gold. Tips are Treasury inflation protected securities. They're basically Treasury securities where the principal is indexed for inflation, so you can't get your principal inflated away. Gold and tips have this very tight correlation over time. They both tend to move when inflation expectations are high or at least stable, and when real interest rates are falling. So there's the monetary easing going on at the same time as inflation is high. So stagflation light is what we've been calling it. It's just about the best environment you could think of if you want to own tips or gold. So this is not happening because inflation expectations are rising. They really haven't risen very much. It's the sense that the Fed is becoming reflexively more dovish for the economic scenario that we're in that's really been driving both of these things higher. The Fed is only likely to cut rates by more than what's currently priced in if the labor market gets worse from here. You can see these labor market surprises that Bloomberg tracks. To the extent labor market data is disappointing, it has tended to drag down the market's impression of where the federal funds rate is going to be at the end of next year. And the worse the labor market gets, the more we're likely to see the market's price in Fed cuts. In which case, longer duration treasuries would be the play here. They will continue to rally if and when we see a continued deterioration in the labor market. Now, the flip side would be that a stronger labor market might imply the Fed's not cut by as much, and that would be bad for all the things that have been doing well lately. But that may not be true next year if, as I said earlier, if new Fed leadership and the composition of the board of governors is going to put rates on a downward course, a preset downward course to 3%, because that's the stated goal, getting to 3%, not necessarily being data dependent or responsive to what's happening in the broader economy. In that scenario, tips and gold would continue to be among, we think, the best performers in a portfolio, because inflation would still be firm in that scenario. We wouldn't be seeing an economic collapse necessarily, but we would be seeing real interest rates continue to fall, which favors those things that have been rallying recently with, again, this dovish move from the Fed. One thing I wanted to mention before I let you go, the fourth quarter outlook from NewEdge Wealth. We will be doing that on Wednesday, October 8th at 4 p.m. Eastern Time. There will be a link in the notes for this video that will allow you to click and register in advance so you can see that video with us in real time and ask questions. We do hope you join us for that. We're excited to share our thoughts with you for the final sprint, the final 3 months of 2025. Thanks very much for being with me. See you soon.